Hi everyone, this is Rob Roy and welcome to the Elliott Wave Elite U.S. Market Update. Very interesting going on in the U.S. market as the volatility continues and certainly continued on Monday. But as a refresher, we have a large pattern of ABC corrective patterns as far as the larger Elliott Wave patterns. So I want to focus on these corrective patterns that we've talked about, flat zigzags and triangles, and remind you that we had that impulse A wave to the downside. Then we have the B wave correction that went exactly to the 50% corrective level, followed by the C wave extension, which went exactly to the 100% level. So just a very classic zigzag. Then last week we were talking about whether or not we were getting a triangle that was kind of a not well-formed triangle, but the potential for a triangle right in this area. And clearly the market has broken out and moved without completing much of a symmetrical triangle there. So we're going to focus on the directional part. Now what's interesting is if we take a look at this big move to the downside as a single pattern, and then look at the fib retracement levels from that main impulse down, look what happens. You can see that the market recovered right back exactly to the 61.8% fib level, which is my favorite level, by the way. I feel like it's the strongest and most accurate. And we have a doji also on the charts that occurred on the 8th of November. So you get a doji right at the 61.8% retracement level. Now, that would mean that we could potentially be setting up to where this is a complex A impulse, which would mean that we would label the original zigzag that we talked about with smaller letters. It's what you do for complex waves, or a wave within a wave, pattern within a pattern, however you want to view it. And so this was the C wave extension, but that was a zigzag pattern possibly within a larger impulse A. And then we would have had a monowave corrective B right to that 61.8% level. And then that means that we now have a qualified, nothing is ever 100%, but it does now qualify as a potential downward zigzag. If that were to occur using the fib extension tool, we would note that our target for the 100% extension, which is what you look for with a 61.8% correction, would be all the way down somewhere around 24.76, something along those lines. So call it right around 24.75 for a C wave impulse to the downside. So I wanted to share that with you. On the other side, it would go against the seasonal trends. We're entering the holiday season. Investment managers tend to close up their books. Traders go away on vacations, and volume dries up. And there's an age-old expression, never short a dull market. What normally happens is as the volume dries up, the markets just tend to drift higher through the holidays. It's nothing volatile or strong moves. They're just like this slow, steady drift to the upside through the holidays, and then everybody reconvenes in January and we figure out what's going to happen from there. So if this C wave to the downside were to occur, it would certainly be going against the seasonal trend of the market. And a lot of people look at that, what happens in seasons. I'm not as big on that, but it's hard to argue the fact that the majority of the time throughout the holidays in November and December, we tend to get drifts higher. So we have a rough October, we drift higher in November and December. Happens all the time. So this is going to be very interesting to see if this plays out, if this entire large zigzag pattern plays out. So we'll see how that works. Looking over at the SPY for volume, bring volume into the mix. Volume stays elevated. It's come down from where we were the past couple of weeks on that downward zigzag pattern. and on the correction, it's fallen off a little bit. You'd expect that as well. One thing that's interesting, though, is that on this big down day on Monday, it was still just above average volume, so there wasn't any real heavy volume in the move to the downside, but we also haven't had that just blowout bottom either, where it's just everybody sells. You get panic selling, and you get a big move to the downside with massive volume, and that tends to give you a tradable bottom when that occurs. We haven't had that happen. We had some pretty good volume on the initial part of that downward move right in here, these volatile days here, but other than that, it hasn't been that significant, and it certainly hasn't been the blowout type of volume that I'm discussing. So my point is that would lend some credence to the C wave correction continuing to the downside, and boy, if that were to happen, that would definitely scare the heck out of everybody and cause that volume spike that I talk about. If we go back to the VIX and put the Elliott wave on, it has relabeled, which means that that 4 wave to the downside took out the 1, so it relabels. That means that zigzag pattern becomes disqualified, so you no longer look at those targets to trade it. We did have a little bit of a gap down in volatility here, but as I've talked about over and over again, gaps get filled. Not always a rhyme or reason as to when they're going to get filled. Sometimes they get filled immediately, sometimes it can take months, but the gaps always get filled. It's just an interesting phenomenon that has occurred consistently over my 20 plus years of trading. So I trust in that gaps will get filled. My point is, on Monday here, with the move back up in volatility, we did close that gap. We actually pretty much closed it on Friday's trade, but volatility stays elevated. It looks like we are finding some support in this 16 area, which was kind of some resistance area for the last several months or the early part of the year, and so old resistance becomes new support. If that's true, that's great for us, because that's the one thing option traders want, is volatility. The more volatility, the better. Looking at our current case studies, we had TBT. Remember, that was in a 5-wave pattern to the upside, larger Elliott wave pattern, directional pattern. However, what we were trading was this, or are trading this triangle, the Elliott wave corrective triangle. And when we got the breakout to the upside, we had a breakout day, no follow through day. We had another breakout attempt day, nothing following through from there, and then now we have the big move lower. And we talked about the two different cases. If the economy does well, we start seeing more and more signs of inflation. That would drive interest rates higher, especially on top of the Federal Reserve raising rates. But if this downward zigzag pattern that we've been illustrating still occurs, then that would certainly be ammunition for TBT to move lower. And the reason for that is when the equities market tends to get, or let's say when fear is elevated in the equities market, money moves into bonds. And the way bonds work is you buy a bond, the price goes up. So as demand for bonds, you're buying them. Buying when price goes up, yields and rates go down. So when money leaves the equity market and it goes into the bond market as a, quote, safe haven, then interest rates go down based on the fact that there's so much buying. So anyway, that's the two fundamental scenarios for which way we could break out. But the one thing that we do know for sure right now is this breakout move to the upside was never confirmed. So we're right back now. We're testing the breakout point, and whatever happens from here may very well be the breakout move that occurs, but still a good pattern, still really like that. MasterCard has been interesting over the week. We had a huge up day that occurred on the 7th of November, and we're in the process of maybe drifting back down to fill that gap. You can see that we did fill that gap today in Monday's trade, but we are still well off that, and it's only the early 31% fib level. We haven't even reached the 38% fib level on the wave 4. So MasterCard, considering the state of the market, is staying very strong. And if the market does calm down a bit and we don't have that extended C wave to the downside, we could see this wave 5 resume sooner rather than later. Otherwise, it may want to go through a series of flats here and bounce around. We'll just have to wait and see. But stock's staying very strong, and for those of you that are Warren Buffett fans, he announced a big position in MasterCard, so he's obviously looking at something that he likes. But we're looking at the technical side, where he's looking at the fundamental side. Last week we started a case study with PLCE. Sometimes it's better to be lucky than good, because we talked about it on Sunday, and then on Monday morning it opened to the downside on the back of an earnings report, but it has been building since then, and it hasn't really set up a significant wave 4 correction yet, so we don't know for sure that we're even in the wave 4 corrective mode. We could still be just in this back and forth. Maybe it moves into a zigzag or a flat, or you could also see the beginnings of a potential, I'm not calling it one yet, but a potential triangle here that could be the catalyst for it to move either down and set up the wave 4, or move back to the upside and possibly label this a 4 at that point in time. We'll have to wait and see, but considering the fact that the stock opened to the downside on the 5th, that gave us in our case study an actually better entry price, and we've been moving up since then. So from that standpoint, things worked out really well. The case study we'd like to look at for this week, based on the uncertainty of what could occur in the market, I wanted to stay with corrective triangles. There was no bullish directional positions that showed up in my search. Isn't that interesting that nothing in the entire market showed up as being in a bullish trend, at least not as far as Elliott wave is concerned, in addition to the indicators that I use to complement the Elliott wave. But here we have a nice triangle, pretty good size one, and Unilever tends to move quite a bit. So there we are with the set of lower highs and the higher lows, and we'll see how this one breaks out. It's got a pretty good mouth to the wedge with the high. You don't even have to go up here. I would consider this the top of the mouth of the wedge due to the fact that we have so many more touches to the line. So 57 down to 52, 5-point breakout. Multiply that by 0.8. So we'd be looking for a move of 4 points in either direction, and that should happen in the very near future based on this pattern, because you can see how nicely formed it is. So that's the one I wanted to share with you. If we get some volatility, this should move quickly as well. But it's going to be interesting to see what occurs with the SPX, the cash index in general. Hope you've had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.